Hi, Mike Wright here. It's the fifth day of Christmas, and today we're going to talk about 5 potential reductions to income that you may or may not have been aware of. And if you were aware of them, this will simply be a reminder of that, and in some cases, what you need to do in order to take advantage of it. First thing is, and it's probably the least likely to be available for you, and that's the casualty loss deduction. Now, the casualty loss deduction is basically a reimbursement for casualty losses such as thefts, fires, or other kinds of disasters that weren't planned for. It doesn't have anything to do with any kind of depreciation or normal wear, but it's a sudden casualty loss, which means something that at one point in time a product or an item that you owned was worth so much, and after that point of time it was worth so much less. Car wrecks, fires, I've mentioned several of them. Now there are some provisions in this, and this is why it doesn't come up very often. First one is any reimbursement for insurance purposes that you receive must be deducted from the total casualty loss. That's the very first thing. Then if there's anything left over, it has to exceed, they take a $100 deductible out, and then it has to exceed a percentage of your adjusted gross income. And if there is anything left over at that point, then you're entitled to have a deduction. This is not a huge benefit, I must admit, but it is a real benefit if you can take advantage of it. So if you had some kind of casualty loss this year, be sure to get this information together and see how it interacts and jibes with your insurance settlement. The nice thing about it is that the documentation that you'll need for the casualty loss is basically the same information that you used to prove your loss to your insurance company. So be sure that you've got copies of those forms that you filed with your insurance company, and we'll take care of that. Next thing we want to consider is moving expenses that are an adjustment to income. I mentioned them earlier about record keeping, but if you've moved this year to a new job location, this doesn't apply if you simply moved from one house to another because you wanted to upgrade. But if you've moved to a new job location and the commute from that job location from your old house, I'm sorry, I should say this the other way around. If the commute from your new house to that job location is more than 50 miles from the commute from your old job location, then you're entitled to this deduction. It's fairly comprehensive. It includes the cost of actually moving. It includes one night stay while you're getting set up. It includes one night stay while you're moving out. And it also includes any travel expenses if you drive. Well, it includes more motel expenses if you drive from your new to your old location. If you fly, it includes the cost of your airline tickets for you and your entire family. Do keep in mind, however, that there is a different mileage rate for this than the business mileage rate. And also, it does not include meals for any of these benefits. Again, you'll need documentation, the receipt from your mover, the rental company, if you rented a vehicle, mileage receipts or gasoline receipts to prove the mileage, and so forth. Gambling is also an item that you might not have thought about. You probably are aware that any gambling winnings that you have are taxed as income. And the losses that you incur, in other words, the bets that you make, can offset those winnings up to the amount of the winnings, which simply means that you can't take a loss on your income other than for the gambling income itself. So let's say you won the lottery for $100,000 and you bought $20,000 lottery tickets in order to accomplish that. As long as you can prove you spent the $20,000 on the lottery tickets, you get to reduce your winnings by that $20,000. Couple things you want to remember: the gambling deduction is taken on Schedule A, which means it's only a deduction on your federal return. you will pay the tax on the full gambling winnings on your Indiana return. This may vary for those of you who are in other states, so you'll need to check to be sure. Also, in Indiana, winnings for the Indiana lottery, including the Powerball and the Mega Millions, are not taxed for Indiana, but only those winnings. So if you like to frequent the casinos or some of the racetracks, your winnings there will be taxed by Indiana in the full amount. Again, it's a matter of record keeping. Oftentimes the casinos, if you have a membership with a casino, will give you an annual statement of your winnings and your losses, and those are very valuable to be able to document the deduction that you're eligible to take. So that's the first three. The next one is kind of a bonus because it actually has several parts in it, and that has to do with education. There are four basic kinds of educational reductions that you may be eligible for. There's the adjustment for adjusted gross income on tuition. There's the credit that's called the American Opportunity Credit. There's the credit that's called the Lifetime Learning Credit. And there's also a possible business deduction as an employee for other things for which there's an eligibility issue for the other three. There's details to remember on all of these, but the point is that whenever you examine your tax return, you're going to need to have all of the documentation, receipts, 1098-Ts, all of the other documents that you get so that the proper amount of money can be used. And because there's a variety of places where this money may be able to be allocated, we need to fix up your tax return in several ways in order to be sure that you're getting the maximum amount both on your federal and your state taxes. And then finally the fifth one, and this does only apply in the state of Indiana, but it's really a good one for those of you, and I know those are most of my clients, and that's the two education reductions that apply only to Indiana. First is the $1,000 credit for 529 plan contributions, and this can be taken by anybody up to the grandparents of a child. So if you're a grandparent and you donated or deposited money in your grandchildren's 529 plan, you're entitled to this credit. It applies to husband and wife together, but for a married couple can be up to $1,000. It also applies per child, so that means you can have $1,000 per child if you have separate accounts for each one of them. That's a very good program. There is no deduction on the federal side for 529 contribution. The federal benefit is that when the money is taken out of the 529, it's done so tax-free because the original tax has already been paid. Secondly, there's also a homeschool, private school deduction in Indiana that many people overlook. It's per child. It's $1,000, and it applies for any expense that relates to a child that's homeschooled or goes to a private school. The basic downside of this is that if your child is also registered in the public school, they are not eligible for any of this money. You're not eligible for any deduction for this. It's only for children who are strictly homeschooled or schooled in a private institution. So there you have it, 5 quick ideas. Give me a call if you want to find out more about it, or email me, and we can talk more in detail about your specific situation. But as I said, these are some that oftentimes get overlooked. I'll look forward to talking to you tomorrow for the 6th day of Christmas.